The rate increase cycle is over and the interest rate lowering cycle has begun. What's this going to do to the housing market? Hi, this is Todd Baker and welcome to this week's episode of Todd Talks. The Federal Reserve this week announced that there are going to be at least 3 rate cuts next year. The Federal Reserve funds, just so you understand how it works, their interest rates affect prime rate, which banks use to determine auto loans, boat loans, RV loans, business loans, home equity lines of credit, and adjustable rate mortgages. However, since 1913, whenever the Fed tightens or raises rates, fixed rate mortgages trend along with that. And every single time when they lower rates, they trend along with it as well. It's something that I've been predicting all year was going to happen. So what's happened in the last 4 weeks, rates peaked out at 8%, and now they're down as an average of about 6.8% for owner-occupied with perfect, like really good credit score, 740. That's the average interest rate in the United States. So that's great news. So let me explain why it's so important. If you were thinking of selling, or you're thinking of buying, or you're a first-time home buyer, there's a huge window of an opportunity right this second to think about giving me a call, reaching out, sending me your family and friends. If you're one of our realtor partners, make sure you're sharing this message with your clients as well, is that the purchase season actually begins at the beginning of January. Application data historically for purchase goes up in January, and then it takes 2 or 3 months to see the sales. So that's why you always hear, well, the selling season is April through June or July, and then it sort of wanes down, and then there's another uptick right before Christmas, and then there's a few months cold in winter. That's the normal cycle, but what happens is it begins in January, and right now rates are still high enough and there's still enough inventory sitting. It's still slow for sellers, meaning they're not immediate sales. They're willing to negotiate. Just so you guys know, almost every transaction, in fact, every transaction I'm closing in December, every single one had a seller concession of at least $10,000 up to $20,000 in some cases, which we use to either cut the cost to borrow in terms of really low, much better interest rate than current market rate, or cut the out of pocket. And here's the secret. You can refi later with our rate protection program when rates drop, because what we also know historically, guess what happens? When rates drop, it spurs buyer demand. So more people are going to go buy homes. And of those, it's going to spur a tremendous amount of new home buyer, which is millennial and Gen Z. When a new home buyer comes in as a buyer, it doesn't increase inventory because they don't have a house to sell. So we're going to have increased demand with more buyers and sellers. And what do you think that does? For all of us that took economics in either high school or college, or have studied it at all, you know that if demand outweighs supply, price goes up. That's what's going to happen. And that's what I've been predicting for a few weeks now, is that we're likely to see a 5 to 10% increase in prices over the next few years with heavy competition. So take this message, share it with anybody sitting there thinking, get off the fence. I'm thinking about buying a house. Get off the fence now. I could build a perfect mortgage plan for you, and we can still take advantage. Probably my guess is until March, maybe April, but most likely it's going to be like January, February, maybe a little bit into March, where we're going to be able to get deals from sellers. Once they start getting multiple offers, it's going to be the opposite side of that. And anybody that needed either a contingent sale, a contingent offer accepted if you're a seller, or any kind of concession, they're probably going to be gone. So thanks so much, and please feel comfortable reaching out to me with any questions. Have a great day.